Somewhere right now, two people are starting their money journey at the same time. They earn the same salary, they have the same bills. At the end of each month, both have about $400 left. But what they do next will change everything. One person spends months watching videos, reading articles, and waiting for the perfect time to invest. The other person takes a simple step. He picks a basic fund, sets up automatic investing, and moves on with life. Fast forward 30 years. The simple investor becomes wealthy. The overthinker struggles. Not because he was less smart, but because he delayed action. This video is not about being a genius. It's about not getting in your own way. If you've ever opened an investing app and felt confused, you're not alone. By the end of this guide, you'll know exactly what to do with your money, step by step, in a way that actually works in real life. Let's be honest about something important. The year you're starting matters, and right now the investing world is a bit strange. Markets have gone up strongly in recent years. When things go up a lot, they usually become expensive, and when things are expensive, future returns tend to be lower. That's just how math works. But here's the mistake most people make. They think, let me wait for the crash. It sounds smart, it feels safe, but this thinking has cost people more money than almost anything else, because the market doesn't move based on your feelings. It doesn't send you a message saying, now is the perfect time. People who wait often wait forever, and while they wait, time passes, and in investing, time is everything. So the question is not, is this the perfect time? The real question is, are you ready to start building your future today? Think about this for a moment. Your money is either growing or shrinking. There is no middle ground. If your money is sitting in a normal bank account, it might feel safe, but inflation is quietly reducing its value every year. Let's say you have $10,000 saved. After 10 years, it still shows $10,000, but what it can buy has reduced. Maybe it now feels like $7,000 in real value. You didn't lose money in a visible way, but you lost buying power. And that's the silent problem most people ignore. Now compare that to investing. Over long periods, the stock market has grown consistently. Not every year, some years are bad, but over time, it grows. That growth is what builds wealth. So doing nothing is not neutral. Doing nothing is actually a decision, and in most cases, it's the wrong one. Now let's talk about something powerful but often misunderstood: compounding. This is where money starts working for you. At first, it feels slow, almost boring. You invest $1,000 and maybe you gain $100 in a year. That doesn't feel life-changing. But here's what happens next. The following year, you earn on $1,100, then on $1,210, then more. The growth keeps building on itself. Over time, this becomes very powerful. But here's the part most people don't like. In the beginning, it feels like nothing is happening. For years, progress looks small. This is why many people quit early. They expect quick results, but wealth doesn't work like that. It grows quietly, slowly at first, then faster. The people who win are not the ones who start perfectly. They are the ones who stay consistent long enough to see the effect. But here's a hard truth. The biggest risk to your money is not the market, it's your behavior. Many people invest, but they don't get good results. Why? Because they react emotionally. When the market goes up, they feel confident and invest more. When it drops, they panic and sell. This cycle repeats. Buy high, sell low, and this destroys returns. There have been studies showing that average investors earn less than the market itself, not because the market is bad, but because people make bad decisions at the wrong time. Now think about this. What if the problem is not the investment? What if the problem is how you behave? That changes everything, because now the solution is not finding the perfect stock. The solution is building a system that protects you from your own emotions. Here's something that might surprise you. Missing just a few good days in the market can reduce your returns massively. Over many years, most of the gains come from a small number of strong days, and those days often happen right after big drops. So if you panic and sell during a bad period, you might miss the recovery, and that recovery is where the real growth happens. This is why timing the market is so dangerous. You don't just need to get out at the right time, you also need to get back in at the right time, and almost nobody does both correctly. So instead of trying to be perfect, a better strategy is to stay consistent, stay invested, let time do the work, because in the long run, consistency beats timing. Now let's build your plan from the ground up. Before you invest, you need a solid foundation. First, deal with high-interest debt. If you have credit card debt, this is your top priority. Why? Because the interest is very high, sometimes over 20%. Paying that off is like earning a guaranteed return. No investment can match that safely. So before you chase profits, remove the losses. Next, build an emergency fund. This is money set aside for unexpected situations. Maybe you lose your job, maybe something breaks. Life happens. If you don't have this fund, you might be forced to sell investments at a bad time, and that can hurt your long-term plan. So think of your emergency fund as protection. It keeps your investment journey stable. Now here's something many people ignore: free money. If your job offers a retirement plan with a match, you should take it. This is one of the best opportunities available. Let's say your employer matches part of what you invest. That's instant growth, no risk, no waiting. Yet many people don't use it fully. They leave money on the table. Don't be that person. Even if you start small, make sure you capture that match. It's one of the easiest wins in finance, and over time, it adds up significantly. This is not about being advanced. It's about using what's already available to you. Next comes choosing where to invest. This is where many beginners get confused. There are many options: stocks, funds, accounts, platforms. It can feel overwhelming, but the truth is you don't need complexity, you need clarity. Instead of picking individual stocks, consider a simple approach: index funds. These are funds that track the overall market. Instead of trying to find the best company, you own many companies at once. This reduces risk. It also removes the need to constantly analyze and guess. Over time, this simple approach has outperformed most professionals. Yes, even experts struggle to beat the market consistently. So instead of trying to be smarter, you can choose to be more consistent. Now think about this. If most wealth in the market comes from a small number of companies, how do you make sure you don't miss them? By owning the whole market. That's what index funds do. They give you exposure to everything. You don't need to guess which company will succeed. You benefit from the winners automatically. This removes a lot of stress. No constant checking, no worrying about missing out. Just steady participation. And that's what builds wealth.
Let's talk about simplicity, because simple often beats complicated. You can build a strong portfolio with just a few funds. One that tracks your local market, one that tracks international markets, and maybe one for stability, like bonds. That's it. You don't need dozens of investments. In fact, too many choices can lead to confusion, and confusion leads to inaction. So keep it simple. Simple is easier to maintain, and consistency is more important than complexity. Here's another important idea: automation. This is one of the most powerful tools you can use. Set up automatic investing. Every time you get paid, a portion goes into your investments. You don't need to think about it. You don't need to decide each time. This removes emotion from the process. It also builds discipline. Over time, this habit becomes your biggest advantage, because while others are reacting to news, you are steadily building your future. Now, you might ask, when should I invest? The answer is simple: regularly. Not based on news, not based on fear, just consistently. This approach is called dollar cost averaging. You invest a fixed amount over time. When prices are high, you buy less. When prices are low, you buy more. Over time, this balances out, and it keeps you moving forward regardless of market conditions. Let's make this real with a simple example. Imagine someone investing $500 every month. At first, progress is slow, but over years, it grows. Eventually, the growth becomes noticeable, then powerful, and finally, life-changing. The key is not the amount alone, it's the consistency. Even small amounts matter because they build the habit, and the habit builds the future. Now here's something important. Avoid unnecessary costs. Fees might seem small, but over time they reduce your returns. A 1% fee might not look like much, but over decades it can take a large portion of your wealth. So choose low-cost investments. Keep more of your money working for you. This simple decision can make a big difference. Be careful of things that sound too good. Complex strategies, quick profits, guaranteed returns. These often come with hidden risks. Many industries profit from your confusion. They sell complexity because it benefits them. But your goal is different. Your goal is long-term growth. And for that, simple, low-cost, consistent investing works best. Let's reset your expectations. You don't need to be perfect. You don't need to start with a lot of money. You don't need to understand everything immediately. You just need to start and stay consistent. Over time, your knowledge will grow. Your income may increase. Your contributions can increase. But the most important step is starting. Here's a question for you. What matters more, getting the best return or actually sticking with your plan? Because the best plan on paper means nothing if you abandon it. So choose a strategy you can follow even when things get tough, because they will. Markets go up and down. That's normal. The goal is to stay steady through both. At some point, the market will drop, maybe 10%, maybe 20% or more. This is not a failure. This is part of the process. When it happens, your job is simple. Do nothing. Keep investing. Stay calm, because those who stay invested recover. Those who panic often regret it later. Think long-term. Wealth is not built in months. It's built over years and decades. The earlier you start, the more time you have, and time is your biggest advantage. Even small steps today can lead to big results later, but only if you stay consistent. So here's your plan. Pay off high-interest debt. Build an emergency fund. Use employer benefits. Invest in simple index funds. Automate your contributions. Avoid unnecessary fees. Stay consistent. Ignore noise. That's it. No secret tricks, no complex strategies, just a clear path forward. And here's the final truth. You don't need to outsmart the market. You just need to stay in it. The people who succeed are not always the smartest. They are the most consistent. They show up, they keep going, they don't quit. And over time, that makes all the difference.